385%. That's the return you would have received had you invested in MicroStrategy at the start of this year. It's easily one of the most popular stocks in the world. For many, it stands as a symbol of the sheer absurdity of this market, a reflection of the 18-year super bubble that's been inflating ever since the 2007 recession. If you're unsure what this company actually does, you're not alone. Many of its investors are equally in the dark. This is our market's modern-day tulip. A perfect blend of degeneracy, greed, and brilliant marketing masquerading as a software company with a thick coating of Bitcoin for extra allure. So why am I making a video that will probably get very low views about this one specific niche stock? Well, because it perfectly captures the essence of this mysterious mega bubble in all its glory, and to understand it, you need to begin not at the start, but in the middle. The story might surprise you, and my thoughts might not be as you think. This could very well be the opportunity of a lifetime or the biggest fraud in capitalism, a stock that the market has never seen before. You see, MicroStrategy just had its quarterly report back in late October where they went over key aspects of their business. This slide here on page 17, infamously covered by Mark Meldrum, is really the key to understanding everything right and wrong with this company. So can this one slide really prove that this billion-dollar enterprise might actually be a massive Ponzi scheme as some critics suggest? Well, it turns out there's a lot to unpack just based on this alone, so let's quickly start with the basic premise of this company. On paper, MicroStrategy is a software business, but if you dig into the details, you'll quickly discover that the software division is consistently unprofitable. So in my opinion, it's fair to say that the majority of the company's value is tied to its Bitcoin holdings and the acquisition strategies linked to them. And that's not really a surprise. Everyone basically knows this, but here's the real puzzle. If the business isn't generating cash flow or profits, how can the company afford to keep buying Bitcoin? And why would anyone feed into this? Where is the value? Why not just buy the asset, in this case, Bitcoin? Now, this is where the concept of intelligent leverage comes into play, a term that feels somewhat paradoxical, and it's also the part that can be complex to explain, so I'll try to simplify as much as possible. MicroStrategy buys Bitcoin by issuing something called convertible debt. Essentially, this means an investor lends money to MicroStrategy, and in return, that investor has two options. They can either receive interest on the loan or convert the debt into company shares at a predetermined price. You don't need to get bogged down in the details, but the key idea is that investors give money to the company expecting either a repayment with interest or shares in return. Boiled down, the basic premise is this: issue debt, buy Bitcoin, and watch the stock price go up. Simple, right? But the stock market isn't that stupid or easy. How does MicroStrategy pull this off, and why is the stock going up in this case? Well, here's where it gets a bit more nuanced. The company's stock price keeps rising because they're increasing their Bitcoin holdings faster than they're increasing the number of shares issued. In other words, they're boosting the asset value per share. This slide shows exactly that. Bitcoin holdings increased by 33%, while the number of shares issued increased by only 13%. How is this possible? Well, let's steer away for a second with a simple side example. Imagine a software company called MicroPyramid. MicroPyramid holds 10 Bitcoins, each worth $1, and has 1,000 shares, each valued at 50 cents apiece. The software business isn't doing well, so to buy more coins, we issue convertible debt. Sounds familiar? Let's say we raise $10 through this debt, which converts to 20 new shares since each share is worth 50 cents. Now we use that $10 to buy 10 more Bitcoins. After this, MicroPyramid holds 20 Bitcoins worth $20 and has 1,020 shares. I sell a lot of numbers there, but the company's assets, the coins, have doubled, a 100% increase. But the number of shares have only increased by 2%. Once again, I'm boosting the asset value per share. And to get even more detailed, I can show you this. Remember, before the debt was issued, I had 1,000 shares worth 50 cents apiece. The company, remember, had 10 Bitcoins total. Now, doing a simple calculation, we can say that each of my shares was worth about 1% of a Bitcoin. After we raised the debt and bought more coins, one share was worth about 1.9% of a Bitcoin. That's a 90% increase in assets per share. So who is paying for this? Where is the magic? Wouldn't everyone be doing this? We know that nothing is free in finance. There has to be balance. So where is the magic coming from? Where is the issue? Well, it's here. This $10 being raised via convertible debt, it represents 20 shares. With these 20 shares, the company bought 10 coins. So each of these 20 shares has a 50% representation in each coin. But once we add this to the pool of shares, it drops to 1.9% representation. So these convertible debt buyers suffer, but they enrich and help those who bought in first. The original shareholders, remember, got a 90% increase in assets per share, while the new money coming in didn't do so good. So all you have to do is raise more money. And that will help these guys out and these guys, but they will suffer. Well, just keep raising, and that will help these guys and these guys and these guys, but they will suffer. As long as you keep raising money, you will keep improving the asset value per share. But who is financing this improvement? Well, it's always the last person in. So as long as you gradually increase these convertible debt rounds, you will continually push up the asset value per share. So if I was the CEO of MicroPyramid, I would say, well, our plan is to raise this much in 2025, this much in 2026, and this much in 2027. And this fancy slide would show our investors our plan. And if you just move some things around, you slowly start to visualize what this really all is. Remember, we have to keep raising new money in larger and larger increments. And if we just flip this around, my company starts to resemble a reverse pyramid scheme where new debt buyers are financing original shareholders and older debt buyers. And if we keep stacking new layers underneath, we keep pushing older buyers higher and higher up the pyramid. And now let's compare this hypothetical scenario to the actual slide from MicroStrategy's quarterly report. It really makes you question what's going on here, but here's the thing, Michael Saylor might actually be onto something, because while all of this might look chaotic or even problematic at first glance, it's also an incredibly unique situation. At the core of this strategy is one crucial factor, Bitcoin. Unlike most assets, Bitcoin has a hard cap supply of 21 million coins, making it inherently scarce. MicroStrategy already owns about 2% of the entire Bitcoin supply. With every additional purchase, they're acquiring a larger and larger slice of the pie, artificially constraining the supply and in turn exerting significant influence over the price. This dynamic becomes even more intriguing when they announce plans like this, diluting their stock price further to raise billions of dollars to buy even more Bitcoin. What happens next? The price of Bitcoin continues to rise, and with it, the stock gains momentum, attracting even more investors. It's a cycle fueled by Bitcoin's scarcity and MicroStrategy's relentless accumulation strategy. So while it may seem unconventional and even borderline fraudulent in structure, this approach has a distinct and undeniable potential to grow the company much larger than it is today. The unique mechanics of Bitcoin, the hard cap on supply, make this possible in a way that wouldn't work with most other assets. Now, I'm not sitting here saying this is going to zero anytime soon, but I am explaining the unique dynamics of MicroStrategy and why their strategy is unlike anything else in the market. Whether you find it brilliant or bizarre or fraudulent, it's definitely one to watch. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know in the comments below what you think about MicroStrategy and its unusual business practices. Is it genius or just reckless? I'd love to hear your thoughts.